In the kingdom of finance, they often said, revenue is vanity, profit is sanity, but cash is king. Indeed, cash was the undisputed ruler, the lifeblood that kept the kingdom thriving. However, as in any kingdom, there were those who sought to manipulate the king for their own gain. The crafty sorcerers of finance, armed with clever spells and cunning schemes, occasionally attempted to deceive the king, casting an illusion of wealth when the treasury was but a facade. They shuffled funds, obscured debts, and played a complex game of smoke and mirrors to make the king appear richer than he truly was. In this eternal struggle between manipulation and transparency, the king's subjects, the investors, stood at the crossroads. They were armed with knowledge and skepticism, knowing that while cash was indeed king, it could also be a puppet in the hands of those who dared to manipulate it. The moral of the story is clear. In the realm of finance, it was not enough to bow before the king's wealth. One must also question its authenticity. And so the kingdom continued its dance of intrigue and enlightenment, where the true power of cash lay not just in the abundance, but in its integrity. Hello and welcome back to Exploring Finance with Prashant. I am thrilled to have you here as we continue our exciting journey in the world of financial shenanigans. In the previous episode, we discussed about the expenses being manipulated to inflate the profits. In today's episode, we are going to discuss cash flow statement, but before that, we are going to dive into some fundamental concepts related to cash flows, that is accrual versus cash based accounting. Understanding this is crucial for anyone looking to navigate the financial world effectively. So take a deep breath and let's start the ride. In the world of accounting, there are two main methods for reporting financial transactions: accrual basis and cash basis. Accrual basis records the revenue when it's earned, not necessarily when the cash is received. And expenses are recognized when the benefit is received, not necessarily when the payment is made. In other words, it's about matching revenues and expenses to the period they relate to rather than when the money changes hands. Now, why is this important? Well, it's because companies are required to report their earnings performance during using the accrual basis. This means that cash inflows and outflows aren't the primary focus under accrual based accounting. However, for investors like you and me, the cash aspect is crucial. Fortunately, accounting rules also require companies to provide a separate statement of cash flows, which highlights the cash inflows and outflows from three main sources: operating, investing, and financing activities. This statement is like a financial map that helps us understand where the cash is coming from and where it's going. The operating section of the statement of cash flow is particularly interesting because it can be used as an alternative performance measure to the accrual based earnings. This is where savvy investors often compare net income with cash flow from operation. And here is the catch. If a company reports growing net income, but the cash flow from operation is shrinking, it might raise concerns about the earning manipulation shenanigans. To give you a clear picture, let's compare the typical structure of an income statement with the operating section of the statement of cash flow. While companies can use either direct or indirect method to present the cash flow, the most opt method is the indirect method. Although net income and cash flow from operation represent different measures of a company's performance, we generally expect them to move in the same direction. So, if a company reports growing net income, it should raise questions if the cash flow from operation is shrinking. In the coming episode, we'll also discuss why cash flow from operation is often considered as the favored son among all the three sections of the cash flow. Investors typically focus more on this section because it reflects cash generated from a company's core business operation. However, companies can use what is called as the Robin Hood tricks to manipulate the cash flow reporting. These tricks involve moving cash inflows and outflows around the statement of cash flows to prevent a more favorable picture. We'll explore some of these tricks and how they affect your assessment of a company's performance. The key takeaway here is that understanding the nuances of accrual versus cash based accounting and the statement of cash flows is essential for investors like you and me to detect the cash flow shenanigans. In the next few episodes, we will delve deeper into the specific techniques used by companies to manipulate these statements. Let's get on with the first cash flow manipulation technique today, that is shifting financing cash flows into the operating sections. In twins, the twins were born in a genetic lab, the outcome of a secret experiment aiming to create the perfect child. Doctors manipulated the fertility process to channel the desirable traits to one child, creating an intelligent Adonis, played by Zeneca, while simultaneously crafting this enormous, conniving twin brother portrayed by DeVito. Interestingly, it was the same year, 1988, when the new cash flow reporting standards, specifically SFAS 95, took effect. These standards officially formalized the statement of cash flows, dividing it into three sections: operating, investing, and financing. Now you might wonder why this cinematic tale have to do with finance. Well, it turns out that while some were watching Twins, corporate executives were reviewing the new cash flow reporting standards. It seems that, inspired by the concept of manipulating the desirable traits in the movie, some corporate minds sought to manipulate the statement of cash flows by sending all the desirable cash inflows to the most important section. Can you guess? Yes, the favored son, the operating section, while shunting the unwanted cash outflows to the other sections, that is, investing and financing. In the recent years, many companies have seemingly operated their own twin genetic labs, not to create the perfect child, but to craft the perfect statement of cash flows. Let's get on with the first technique, recording bogus cash flow from operation from a normal bank borrowing. You can say a sub technique. At the end of 2000, Delphi Corporation was in a tight spot. Despite being spun off from General Motors just a year earlier, it was determined to appear strong as a standalone operation. However, problems were brewing beneath the surface. In the fourth quarter of 2000, Delphi's situation worsened. It faced the grim prospect of revealing a severely negative cash flow from operation for the quarter. This would have been disastrous as Delphi have been touting its cash flow from operation as a key performance indicator. To avoid this, Delphi devised a scheme in December 2000. They offered to sell $200 million in precious metals inventory to their bank, Bank 1, with a clever arrangement. Bank 1 could sell the inventory back to Delphi a few weeks later, effectively giving Delphi a short term loan. Delphi recorded this transaction as the sale of inventory, inflating revenue and earnings, as well as overstating the cash flow by $200 million. This incident serves as a reminder that when a company engages in questionable revenue practices. It may also be a signal that the cash flow from operation is inflated. It's crucial for investors like you and me to remain cautious, especially when the management introduces company created cash flow metrics that subtly redefine the cash flow from operations. Off balance sheet structures can be a breeding ground for inflated cash flow from operation, as exemplified by the notorious case of Enron. It employed various schemes, including the use of off balance sheet vehicles like special purpose entities to paint a falsely robust picture of its cash flow from operation. One of the Enron's techniques involved creating these vehicles and helping them secure loan by co-signing these vehicles under the Enron's control would then use the borrowed cash to seemingly quote unquote purchase commodities from Enron. Enron in turn recorded the cash received from these transactions as an operating section inflow, which boosted its cash flow from operations. Despite the complexity of these arrangements, the underlying economics were rather straightforward. Enron was orchestrating transactions to sell commodities to itself. The issue was that only one side of the transaction, the cash inflow, was recorded. Enron acknowledged the quote unquote sale of commodities as an operating inflow, but conveniently disregarded the corresponding outflow from the vehicle's purchase of these commodities. Had Enron accurately represented the transaction's economics, the cash inflow would have been categorized as a loan and recorded as a financing inflow. This crafty maneuver allowed Enron to artificially inflate its cash flow from operation by billions of dollars, ultimately harming its financial cash flow and, of course, its unsuspecting investors. So, what did we learn from this technique? First, beware of sham transactions. Companies sometimes engage in deceptive transactions to artificially boost their cash flow from operations. Delphi Corporation, for instance, portrayed the sale of $200 million in inventory to its bank as an actual sale when it was in fact a short term loan. Such maneuvers can mislead us and distort a company's financial health. Second, revenue manipulation may include bogus cash flow from operation. Manipulating revenue, as discussed in the previous episodes, can also inflate the cash flow from operations. In this case, we are discussing about Delphi, where the bogus revenue was recorded from inventory sale to the bank. It contributed to an inflated cash flow figure. Third, exercise skepticism with non standard metrics. Companies may use non standard cash flow metrics like operating cash flow to divert attention from reported cash flow from operations. Delphi, for instance, emphasized its operating cash flow, which differed significantly from its reported cash flow from operations, leading to the confusion for investors. It's crucial for us to critically assess such metrics and stay skeptical when management focuses intensely on non standard cash flow measures. Let's move to the next technique, that is, selling receivables and inflating the cash flow from operations. In the preceding section, we explored how Delphi and Enron concocted schemes akin to the twins' genetics lab, enabling them to report entirely fictitious cash flow from operations. In this section, we delve into a common and seemingly legitimate practice used by companies to bolster their cash flow from operations, which I am going to refer in future as CFFO, selling accounts receivables. However, the way these transactions are portrayed on the financial statements frequently results in substantial investor confusion. Companies frequently employ a cash management strategy of selling accounts receivable, a seemingly straightforward process. In such transactions, a company seeks to collect its accounts receivable before they become due. by finding a willing investor like a bank. The company then transfers the ownership of certain receivables in exchange for a cash payment minus a fee. Now, let's consider the essence of this transaction, its purpose, and the interest of the other party involved. Does this arrangement resemble financing or an operational activity? Many would argue that when a bank simply issues a check, it resembles a conventional loan, a form of financing. After all, the management determines the timing and the amount of cash received. However, I think the accounting rules have a different perspective. They dictate that cash generated from the sale of receivables should be recorded as an operating inflow and not a financing inflow. Why? Because this cash can be seen as representing collections from previous sales. This nuance can be a source of confusion for even the most astute investors. In 2004, pharmaceutical distributor Cardinal Health faced the urgent need to generate a substantial amount of cash. To address this challenge, management decided to sell accounts receivable, providing a quick cash infusion. By the end of the second quarter in December 2004, Cardinal Health had successfully sold $800 million worth of customer receivables. This transaction became primary driver of the company's impressive $971 million growth in cash flow from operations compared to the prior year. While it's true that Cardinal Health had every right to receive the cash in exchange for its accounts receivable, investors should have recognized that this was not a sustainable source of cash flow growth. Essentially, Cardinal Health collected on receivables from a third party that would typically have been collected in the future quarters. By accelerating the cash receipt ahead of schedule, companies effectively shifted the cash flow from future period to the current quarter, creating a potential gap in the future cash flow. This transfer of cash flows to an earlier period could lead to disappointing cash flows in the future unless management finds another financial maneuver to fill the gap. Even novice investors could have detected a significant change in the Cardinal Health's accounts receivable, which was the primary driver of the cash flow from operations growth. A closer look at the company's statement of cash flows reveals that $971 million increase in the CFFO was primarily attributed to a remarkable $1.1 swing in the accounts receivables. Specifically, in the 6 months ending December 2004, the change in the accounts receivable resulted in a cash inflow of $622 million, whereas in the previous year it had contributed to a cash flow of $488 million. In the essence, the massive sale of receivables rather than an improvement in the Cardinal Health core business operations produced the impressive cash flow from operations growth. The key lesson here is that investors should not only focus on how much cash flow from operations has grown, but also understand the source of that growth, an important distinction. Also, a sudden and significant swings in the cash flow from operations, such as those observed in Cardinal's case, should prompt deeper investigation. In this instance, it would have been evident that the company has increased its sale of accounts receivable, a fact that was relatively easy to uncover. Cardinal Health had been transparent about these transactions, disclosing them in its earnings release and its 10Q filings because it's an American company, though presenting them on the statement of cash flow would have been preferred. While some investors might have been impressed by the cash flow growth, the astute investors would have recognized that it resulted from a one time event and not from sustainable operations. While some companies like Cardinal Health may openly disclose their sale of account receivable, others go to a great length to keep it in dark the true source of the cash flow from operations growth. One such example is the case of certain electronics manufacturers, Sanmina SCI Corporation, which reported its fourth quarter results for September 2005. In the initial earning release in early November, Sanmina proudly highlighted its strong CFFO as one of its fourth quarter highlights. Now, the company also drew attention to the decline in the accounts receivable near the top of the release. However, the earnings release didn't tell the whole story. Nearly 2 months later, buried within the 10K filed on the December 29, 2005, when many investors were on holiday, Sanmina disclosed the reality. The primary driver of the cash flow from operations in the Q4 was the sale of receivables. Sanmina revealed that $224 million in receivable it had sold were still subject to recourse at the end of the quarter, a significant increase from $84 million reported in the previous quarter. Sanmina had been quietly selling receivables for a few quarters, but the magnitude of this sale was unprecedented. Without the increase in the receivables sold, Sanmina's cash flow from operations would have been $139 million, dropping to $36 million instead of the reported $175 million. So here are the learning from this technique. First, transparency is the key. Companies should be transparent about the sale of the receivables and provide investors with details on such transactions. Failure to do so can lead to confusion and misinterpretation of the CFFO figures. Investors like you and me should always try to scrutinize the CFFO sources to ensure that they accurately reflect the company's financial health. Deep dive into the cash flow from operations. Sudden and significant swings in the cash flow from operation should prompt further investigation. We should understand the source properly, whether it arises from sustainable operation or from one-time financial maneuvers. Third, learn from historical examples. Well, we just discussed some global crossing and the cardinal health. Well, there are some others like Xerox, which highlight the potential risk associated with the stealth sale of account receivable. Companies may use such transactions to mask the financial troubles or present a misleading picture of their financial health. Let's move to the third technique, or that is faking the sales receivable to inflate the cash flow. In the previous section, we explored the legitimate practice of selling the accounts receivables and the implications for cash flow from operations. While such transactions can be prudent discussion business decisions, it's essential for us to recognize that collecting cash from future periods ahead of the schedule is unsustainable. In this section, we delve into a more deceptive practice that occurs in the twin labs of certain companies: the fabrication of receivables sales. Peregrine Systems engaged in a cover up operation to conceal its accounting fraud. Peregrine had previously inflated its revenue through deceptive practices like recording fictitious revenue and reciprocal transactions, resulting in bloated receivables on its balance sheet. To conceal this fraudulent revenue, Peregrine executed the sham sales of accounts receivable. In this episode, Peregrine transferred its receivables to a bank for cash, but the collection risk remained with Peregrine, as many sales are fictitious. Consequently, Peregrine had to return the cash to the bank when the receivables were uncollected. Economically, this transaction resembled a collateralized loan similar to Delphi's case discussed earlier. Peregrine should have reported it as a financing inflow on the statement of cash flows to reflect its true economic nature. However, Peregrine misrepresented it as a receivable sale, reporting the cash as an operating inflow. We should closely monitor the changes in the risk factor section of the corporate filings, as they often reveal significant developments and potential red flags. In the Peregrine's case, it added a critical risk factor disclosure in June 2001, hinting the significance of its actions. In December 2001, Peregrine included a seemingly innocuous sentence in the risk factors, disclosing its intent to market client receivable balances without recourse. This cryptic disclosure, placed solely in the risk factor section with no mention of this anywhere else, raised serious concerns about the lack of transparency and the company's concealment of the material information from investors. In Computer Associates' 2010K filing, it was disclosed that a significant portion of the company's operating cash flow for that year resulted from a decision made in the fourth quarter to assign accounts receivable to a third party. However, the disclosure lacked the crucial details about the arrangement's mechanics and its impact. I am going to read to you the Computer Associates accounts receivable disclosure of the 10K report. Quote unquote. The primary source of the cash for the year has higher net income adjusted for non-cash charges. Other sources of cash included strong collections of outstanding accounts receivables and company's decision in the fourth quarter to assign the selected existing installment account receivable to a third party. The company may continue to explore the use of financing companies as a means of expediting the debt reduction, mitigating interest rate risks, and reducing the installment accounts receivable balances. This move by the Computer Associates was an attempt to cover up the premature recognition of over $3.3 billion in revenue from 1998 to 2000, similar to Peregrine's tactics. So here are the learning from this episode. From this technique first, then we will go to episode. First, we should pay close attention to the risk factor section in the corporate filings. Changes in this section, even seemingly minor ones, could be a significant and may indicate the undisclosed issues or the developments. Second, it's essential for the investors like you and me to understand whether accounts receivable sales were structured as a recourse or non-recourse. In non-recourse arrangements, the credit risk is transferred to the buyer, usually a financial institution, an NBFC or a bank, and the cash received is considered as an operating inflow. In recourse arrangements, whether the seller retains some credit risk, it's treated as a form of borrowing, and the cash received is treated as a financing inflow without affecting the operating cash flow. Failure to correctly categorize such transactions can lead to misleading financial reporting and misinterpretation by investors. With this, I come to the end of this episode. And here is the final takeaway from this episode. Investors, such as you and me, should demand transparency from companies regarding their cash flow activities. Companies should clearly disclose the nature of transactions, especially those involving account receivable sales or any financial maneuver that can affect the cash flow. Changes in the risk factor section of corporate filings can be a significant and should be closely monitored. Thanks for listening to this episode. In the next episode, we are going to delve more deeper into the operating section of the cash flow statement. Until then, keep questioning, keep learning, and keep exploring the captivating world of finance. Thank you. Have a nice day.